Did you wake up, open your credit card statement, and feel your stomach drop, wondering how a few weeks of holiday cheer somehow turned into a mountain of bills? If that sounds familiar, you're not alone. Millions of Americans are starting 2026 buried under record-high credit card debt, now averaging over $11,000 per household. And the real gut punch? Those balances are sitting under sky-high interest rates, turning every swipe, every minimum payment, into money quietly leaking out of your future. But here's the part no one warned you about. Even as the new year rolls in, those interest rates aren't coming down. Not anytime soon. And it's not an accident. A tangled web of Federal Reserve policy decisions and political maneuvering is keeping borrowing costs painfully elevated, long after the holiday lights came down. So today, we're breaking down why your post-holiday financial hangover is about to get worse, who benefits from it, and exactly what it means for your wallet if nothing changes. Stay with me. Because once you see the mechanics behind this, you'll never look at your credit card bill the same way again. Let's dive in. Let's set the stage, because none of this pain is random. At the heart of it all is the Federal Reserve, or the Federal. They call the shots on the benchmark interest rate that quietly pulls the strings on everything you borrow, from mortgages to car loans to your credit card APR. Right now, that benchmark rate sits between 3.5% and 3.75%, following a modest quarter-point cut in December 2025. Many Americans hoped that would be the start of real relief after the holidays. It wasn't. Rates are still elevated because the Fed is walking a narrow tightrope. On one side, lingering inflation. On the other, maximum employment. Inflation has cooled significantly since its 2022 peak, but it's still above the Fed's 2% target, kept alive by ongoing supply chain disruptions and renewed talk of tariffs. Cut rates too fast, and prices could flare up again. Move too slowly, and households keep bleeding through interest. And this is where politics steps in. Under President Trump, the White House is openly pushing for faster rate cuts to stimulate growth. Trump has even hinted at replacing Chair Jerome Powell with someone more aligned to his agenda. This kind of pressure isn't new. Presidents from both parties have leaned on the Fed before. But in an election year, that pressure intensifies. Why should you care? Because when politics collides with monetary policy, rate relief often gets delayed or distorted. While officials debate behind closed doors, your credit card APR stays painfully high. At that rate, the $1,200 you spend on holiday gifts doesn't just sit there, it quietly snowballs. Interest piles on month after month, turning a festive splurge into a year-long financial headache. Think about it like this. You're the average Joe or Jane, balancing a mortgage, car payments, and rising everyday costs. Prices are still about 20% higher than pre-pandemic levels. Now, with interest rates not falling as fast as promised, you're paying more, not to get ahead, but just to stay in the same place. And in the next section, we'll break down exactly how much that treading water is costing you, and who profits from it the most. Now let's go deeper, because this is where the numbers stop being abstract and start hurting. By late 2025, U.S. credit card debt has surged to $1.23 trillion, up from $1.21 trillion just months earlier. A big driver? Holiday spending. Over one-third of shoppers added new debt, averaging $1,223 per person. That's not just a headline. That's families skipping date nights just to make minimum payments. That's small business owners quietly swiping personal cards to restock inventory, because traditional loans are suddenly too expensive. For everyday consumers, the math is brutal. Carry a $5,000 balance at a 22% APR, and you're paying roughly $1,100 a year in interest. Not to buy anything new, just to exist with debt. And this is why the Fed's caution matters so much. Inside the Federal Open Market Committee, divisions run deep. Cut too fast, and inflation could roar back, especially with Trump's proposed tariffs, which could raise import costs across the board. And when import costs rise, guess who feels it first? You do. Groceries creep up. Gas stays stubborn. electronics cost more. So households lean harder on credit, right as borrowing becomes more expensive. It's a vicious loop. Middle-income households are cracking under pressure. And then there's the stock market, where your retirement lives. After the Fed's December announcement, the S&P 500 dipped about 2%. For your 401k, gains stall. So what can you actually do? There are pressure release valves. Consolidating high-interest debt with a lower-rate personal loan. Calling creditors to negotiate rates. Using micro-saving tools like Acorns to redirect spare change toward savings. Start painfully small if you have to. Cancel one subscription. Redirect that money straight to principal payments. Because in a high-rate world, every dollar that avoids interest is a dollar you get to keep. To be fair, there is another side to this story, and ignoring it would be a mistake. Some economists argue that the Fed's caution isn't incompetence. It's discipline. Cutting rates too fast could reignite inflation, quietly destroying your purchasing power. From that perspective, Trump's push for aggressive rate cuts looks appealing, but risky. Lower rates could juice short-term growth and ease debt burdens temporarily. In a midterm election year, political pressure might even lead to targeted relief programs, student loan forgiveness talks expanding, or soft proposals hinting at credit card relief. And that sounds comforting. But critics warn this is how long-term instability begins. They point to the 1970s, when political interference in monetary policy helped trigger stagflation. A toxic mix of high inflation, weak growth, and declining real wages. So what does this mean for you? It means walking a tightrope. If rates eventually fall, big purchases might make sense, but betting your future on bailouts is dangerous. Political promises change fast. Relief programs appear and disappear just as quickly. No matter who wins the argument in Washington, the risk is being quietly shifted onto your personal balance sheet. So, what happens next? Heading into 2026, expect more noise, not clarity. As midterm pressure ramps up, the Fed is likely to move cautiously. Most projections point to only modest cuts, maybe down to around 3% by year-end, unless political victories force their hand faster. Debt relief packages? They're possible, but they're political tools, not financial plans. Betting your household budget on Washington's generosity is a gamble most families can't afford. So the real play is closer to home. Protect your wallet now. Build or pad that emergency fund, even if it's slow. Shop smarter, not bigger. And pay attention to Fed signals, not political promises. Because here's the bottom line, when rates stay high longer than expected, the system adapts. Businesses adjust. Markets adjust. But households that don't prepare? They absorb the shock. If this breakdown helped you make sense of what's really happening, hit subscribe for more straight talk on how DC decisions hit Main Street. And drop a comment below, what's your biggest debt worry right now? Let's talk, because ignoring it won't make it cheaper.